All right, welcome to yet another class for financial accounting. And with you today is Samuel Ibanda, who is your financial accounting tutor. Today we want to learn more about partnerships, okay? And I'm going to use this ACCA study text material, which I've also promised to share to you. I think it's the resource that I plan to share with you, okay? Maybe just sort of to give you a background, I know we are on the CPA exam, but if you to find out more, you see that our CPA exam has benchmarked a lot on ACCA, okay? So you will find many resources that are a bit similar to what we use at CPA, okay? There's another website that you can also find various tutorials. It's called Open Tuition, okay? It's called Open Tuition. You can note that, especially for my friends that are preparing for the December exam. It's called Open Tuition. It has lots of materials that can help you along your study. Of course, one of the things that you need to know is, as a person who's preparing for the exam, is expound your knowledge, okay? Even away from the class, because we have only 2 hours to study. Yours is to utilize the rest of the time to learn more about the subjects and continue to dig deep, okay? And one of the guidance that that this should give you is also from the past papers that you're actually trying out. You find yourself in scenarios where there are things that you may not know, so that should give you a ground to study, okay? In the previous cases, which is not very common these days, would see even some of our examiners look out for ACCA questions or way of setting, okay? Basically, they don't do copy and paste, but they benchmark on the way ACCA sets its questions, okay? So that is why I recommend ACCA materials when you're preparing for your exam. I will also share this with you. It has worked out examples and so on, though it's in USD, okay? The currency is USD, but the material is all the same, okay? As you can see, just to highlight you here, it's a very rich material, okay? So don't get it and say, this one will I handle ACCA, I ran away from ACCA, okay? It's basically the same thing, okay? Yeah, so whatever you want, just search and you'll be able to get to exactly what you're looking out for. As you can see, the same things that we have the other side, business entity, so on, they're all there. So you're able to learn through advantages of trading as a limited liability company. All their information is all there, okay? Yeah, financial reporting, management accounting, the users of financial information. It's a very rich text. You can just sit and read. Of course, there are things that have some element of UK, but this is the same financial accounting that you find everywhere, okay? Yeah, and there is a trade notes, so you'll find them very good and easy to learn. Okay, so I'll share this with you, as long as you also help me make sure that you're not forgetting on the payment, especially for my friends that have balances, okay? Make sure that you don't forget on us. Very important. I even see the accounting equation here. The accounting equation, and they're even giving you the effects of the accounting equation on each of the transactions, which is brilliant, okay? I think you can see everything right there. So will you really have any reasons to not pass this paper, honestly? I don't think so, okay? So right today, like I said, we want to study more about partnerships. Now, for you to understand that partnerships are a form of business operation, okay? Where we see where we see 2 or more people coming together to form a partnership and run business. Okay, yeah. So here we will try to look at, of course, understanding what partnerships are, but also for us to appreciate the fact that when it comes to partnerships, one of the key documents for partnerships is a partnership agreement. And yours is also to understand what are the contents that could be in a partnership agreement, okay? And when we speak about a partnership agreement, means the terms and conditions under which the different partners will operate, okay? Yeah, and most so when it comes to the profit sharing terms. So that is very key. We shall also try to understand things to do with capital accounts, current accounts, and how we're able to divide profits as well, okay? Things to do with calculating partners' share of profit and losses, accounting for guaranteed minimum profit shares, recording partners' drawings, interest on drawings. Now, the drawings come in because, you know, partners also remove money from the company, okay? So we have such cases. Then we also have, of course, recording interest on drawings. When partners take interest, when they take drawings, sorry, we charge them definitely interest, okay? Because this is company money, so they don't just take it. And this is based on the terms and conditions that the partners may choose to work in. In some scenarios, you'll find them where they really don't have things to do with interest on drawings, but for us just to understand that mostly you'll find this, especially for examination purposes. Then the other is how to record interest on capital. Now, as partners also contribute capital to the business, usually we also reward them by giving them interest, okay? So partners get a reward of interest on their capital contributions. The other is also recording how to calculate and record partner salaries. Now, yours is also to understand that every time we have, let's say, a partnership, we could have a case where one of the partners may be fully involved in the business. They could also be 2 or 3 partners, or all of them involved in the business, and they may have a salary that they basically take home, okay? So that's very important for us to pick there. We shall also try to understand what a current account is and how does that distinguish from a capital account, okay? Now, as we go ahead, you'll understand that the capital account, we have different ways of how partners may run. They can either run maybe a fixed capital account or a floating capital account, okay? And if it's a fixed capital account, it means that we shall have a capital account and then a current account. If it's a floating capital account, then you will find that the capital account will combine the details that appear in the current account as well as those that appear in the capital account, okay? And then we shall go on to also understand how to prepare income statements, including division of profits and statement of financial position of a partnership. And then also go ahead to bring in the aspect of goodwill. And by aspect of goodwill, goodwill also mostly comes in when we have changes in the partnerships, okay? For example, either partners share contribution is changing, or you're admitting a new partner, or there's a partner that is retiring, okay? So whatever scenario might really happen. And then also basically to understand scenarios, okay, that may really creation of goodwill. I've already commented on that. And then being able to calculate goodwill from information that is given, okay? Yeah. So as you can see, saying questions on partnership may include the effect of admission of new partners, just so you can know, okay? Yeah. Okay. So this is just an important guide where they're telling you the examiner highlighted partnership accounts as an area consistently answered badly in the exam. She also emphasized the need to practice full questions on this topic as a foundation for future studies. Now, you also be able to appreciate that even when it comes to CPA exams, partnerships are really a common number, okay? They're a common number. And one of the reasons why partnerships are a common number is that after you, let's say, when you apply for, let's say, for a practicing certificate from ISPAL, you can run an audit firm, and most of these audit firms run as partnerships, okay? So ideally, the assumption is that we need to make sure that our accountants basically understand what partnerships are, okay? So partnerships are very common, and they're actually questions that you should basically master, okay? For example, this is one of the questions. This was set in May 2018, okay? As you can see, a call and a call are partners in an audit firm providing audit and assurance service, consultancy services. Like I told you that this happens, okay? As you can see, practicing fees to ISPAL, it's a typical audit firm, okay? And I think when you get down here, the thing they were asking you to do the journal entries and then to prepare a statement of profit and loss and an appropriation account for true and fair associates, okay? This appropriation account, as we are going to look study, the appropriation account is one that we use to distribute the profits, okay? And it also is the account that records any details around the partner, around the details of the partners in the operation, as we shall see how that exactly appeared. So this question is also a very common question, like I indicated, that you need to be able to prepare for, okay? Yeah, so that is very important. So you can, after this, you'll be able to find very many questions that will have that aspect, okay? Yeah, so back to here. So you just basically know, this is just an exercise that you can basically read, okay? Yeah. Yeah, so like I indicated, partnerships can be just a relationship that exists between two or more people carrying out business with a view of a profit. And I already hinted on the partnership agreement. And I said one of the key things that it looks at is how partners will share the profits. But you know, it can go ahead to also look at things like maybe capital, how much each partner is also contributing. In cases where we have interest on capital, how much will be the interest on capital, things to do with partner salaries, who is part of this, let's say, operations, and what would they be taking home, okay? So this information, be able to find it, and you can be able to read in much detail. Then we have, of course, partner drawings. Like I said, once in a while, you can see partners getting some money from the firm, okay? And we're saying that since this is not good for us, you may have cases where there's also interest on drawings, okay? So partners may also agree on interest on those drawings, okay? So that they basically discouraged, okay? Discouraged partners, okay? So yeah, so this is just a simplistic example which says Bill and Ben are partners sharing profits in the ratio of 2:1, and that they agree to pay themselves a salary of 10,000. If profits deducting salaries at before deducting salaries at 26,000, they're asking you how much income would each partner basically earn, okay? So basically, so you just, you know, this is just a simplistic example, but we are going to look at something in more detail. But just so you know that if this is the profit, let's say before deducting the salaries, now this is the profit in the income statement. But then when you get to the appropriation statement, we now deduct things like partner salaries. So as you can see, we have what? We have the profit, which is 26,000. So we go ahead to deduct the salaries of the two partners, which is 10,000 each, which means this will be 20,000. And that's leaving us with 6,000, okay? So it's from the 6,000 that we go ahead to share in the ratio of 2:1. You know very well that when we are looking at ratios, Ours is to add the 2 plus 1, which gives us the total ratio, which is 3. Okay. So for us to get the component, for example, for bill, ours is to make sure that we are doing 2 out of 3, which is the total ratio, times what? Times the profit that is being shared. So in this case, the profit that is being shared is 6,000. Okay. And if you want to get, for example, the portion of Ben, to be 1 divided by 3, which is the total, ratio, times what? Times actually the profit that we are sharing, the profit that is being appropriated to the partners. Okay. So that is something that is good for you to understand. I hope you remember how ratios work from your either university or whatever level it is. Okay. So as you can see, this is just a demonstration where we have the salaries, total that, and then we have the share of the residual profits after we've deducted, and this is giving us that, as you can see. Okay. So this is just another example that you'll be able to look at when you're doing your personal reading. Okay. Yeah. So we might have looked at this when we are trying to look at business structures, but so you know that the importance or advantages of running a partnership, when we are answering such a question, just in case it does appear, our focus is more on just compare a partnership with what? With, let's say, a limited company, or compare it with the sole proprietor. Okay. So for example, if I'm comparing a partnership with the sole proprietor, definitely I will say that with partnerships, there is more likelihood of sustainability, just in case maybe the owner, one of the partner dies. It's more like that this business can continue compared to having a sole proprietor ship where when you die, everything just collapses. Okay. And I would say maybe with partnerships, you have maybe different skills that are brought together, okay, from the different partners. So you're much better off than one person is running single business. So you can think of many things, even capital. Okay, you can have, if you are alone, it means that the capital that you contribute, yes, of course, in certain circumstances might be maybe better than what two people are adding together. But yours is to understand that if at all you have the same maybe level of earning, your capital as a loan is really less than what two people can actually put together. And in the same thing related to risk, when two or more people are together, it means they are also sharing the risk in terms of if anything goes wrong. Okay. And also understanding that if we are trying to look at the disadvantages, ours is also now to compare it with the sole proprietor and maybe also with a limited liability company. And one of the disadvantages you may look at when it comes to partnerships is the aspect of the delay in the decision making. You find that you have to consult all the partners before a decision can be made. And you also need to basically know that maybe also cases where partnerships are not usually in terms of the partners, partnerships are usually unlimited liability. So the partners bear any liabilities that might come. Okay. And that is why you see some partners choose not only remain partners running a partnership, but they choose to actually register a limited liability company, okay, which ceases to be a partnership by our definition. So, and then also things to do with if you're trying to look at also disadvantages in the same way, of course, when it comes to tax, those that have done maybe a good study of tax, you'll definitely realize that when it comes to partnerships, we don't charge the 30% corporate tax, but rather the partners themselves actually incur, we charge the taxes they elect to the partners, okay? So it means that they really miss out on the tax benefits that might come with a corporate company, okay? Yeah. So you can think of many things around the disadvantages and advantages of partnerships, but that you should know that you just make sure that you just compare these with the sole trader and maybe compared with the limited liability company. You can be able to come up with several of these examples. Okay. Yeah. So that is something very important. So ours is now to dig deeper and understand how do we prepare partnership accounts. Okay. how do we prepare partnership accounts, and how do these differ from preparing accounts for, say, a sole trader. Okay, yeah. So that is very important that we should be able to get to understand. So now, when it comes to, of course, to partnerships, okay, I'll just comment and say that for partnerships, the only differences that might come in, for example, around capital. Okay, of course, the capital account for a sole trader will only have a single, let's say, capital amount because it's a sole trader. Okay, but when it comes to let's say partnerships, we'll have capital distributed into respective partners. So we shall have different columns of each of the partners. Okay, we also have one of the things that you should also understand is that when we are drawing up accounts for sole trader, we basically end at the net profit. We don't go ahead to do the distribution because it's only one person that is in the business. But when it comes to partners, after we've gotten our net profit, okay, we now draw up what we call an appropriation account. And it's that appropriation account that we now make adjustments on our profit before we can actually do what? Distribute it across the respective partners. Okay, so that is very important for us to understand, as we shall also see when we are proceeding. But the rest seem to be the same because you'll be able to see the balance sheet. Of course, in the balance sheet, in the same way, you have the same assets. You have, let's say, when it comes to current and non-current, you have those. And when you even come to, let's say, when you come to liabilities, the same story. And then when you actually come to equity, okay, which is our capital, yours is also to understand that under my equity, if I have capital, I should distribute it. Okay. Now, in most cases, we have, of course, to have to distribute it between the respective partners. That is maybe partner A or partner B, and partner B and partner C. Now, also one of the things that we need to also appreciate that where we have a current account, okay, where we have a current account, the current account also appears under what? Under our equity, okay? So we are going to see, because a current, the current account is basically, it's a lookalike of a capital account, okay? But for it, it basically records the operations between the partners and the business, okay? Basically the day-to-day operations between the partners and the business, things like drawings, things like maybe things like interest on capital and so on, as we shall basically proceed to see, okay? So on average, they are not much different, but we shall see where these are different, okay? Yeah. Okay. So this is just to bring in the aspect of course, the capital that is contributed by the partners. And we, like we indicated, we include that in the capital account. And then we have maybe like a column for each of the partners, okay? Yeah, so that is very good to understand. And then we can have, of course, we have the current account that comes in, okay, right here, but I'll be able to explain more how the current account might come in. Like I said, we have, we can either have capital run as floating or fixed, okay? And in cases where capital is run at let's say at floating, then we actually have a current okay, if the capital is run at fixed, sorry, then we have a current account that records changes that might happen between the operations of the business or the partnerships with that of the partners, okay? Yeah, so like I said, a current account is basically a lookalike of a capital account, okay? Yeah, and as we shall see how it basically looks like, okay? And so, you know, so we get right here. So right here, they're just giving us how we treat drawings, okay? Now, like I said, of course, partners do take take drawings. Okay, it's a common thing to find with partners, just like sole traders, the way they work. Okay, and what we are saying here, that just in case we have drawings that are taken by the partners, ours is to do what? Ours is to, of course, definitely debit our current account of the partners, and then credit our drawings account of the partner. Okay, we shall see how this plays even when we get to at least an example. Okay, yeah. So the financial position under equity will definitely have the capital account and the current account, as we shall get to see. Yeah, so we also have cases where we have loans by partners, and like this I said, what happens here is that partners can lend money to the business, to the partnership. Okay, and what this would mean is that of course the reward to loans to partners is us paying them interest. Okay, is us paying them interest. Now it's not, when you say loans by partners, some students usually confuse these loans by partners with drawings. Okay, now when partners remove money from let's say the partnership, and then they have to return back, those are drawings. But when partners contribute, okay, partners can contribute money in terms of capital, that is one form. But in addition to that, partners can give loans, okay, to the business, and that's, we call them loans by partners. Okay, so that is very important. So yours is to understand that if we have, for example, partner loans, and then there is interest, this interest on such loans has to be credited on the partner's current account. Now, remember we said that the current account of partners is a lookalike of the capital account of partners. So what this would mean is that the current account also has a normal credit balance. Okay, and by it having a normal credit balance means that when the current account is increasing, we credit it. Okay, and remember the current account, like we said, it's basically a reflection of the capital account. It means that when the partner is benefiting, the current account is actually credited. Okay, and that is why you see in this scenario, when we have an interest on loan, this has to be credited to the partner's account. Okay, this has to be credited to the partner's current account. We are going to see this even as we proceed. So that is what we should do. And then the interest on loan has to be catered for as an expense in the income statement, just like the way we do for the private sector. When let's say the owner of the business borrows money, from example, from the bank, that interest is recorded as part of the expenses. So it's the same thing that also happens in this case. Okay, yeah, right there. And then we have the appropriation of profits. Okay, and this brings us to one of the key terms called the appropriation account. So what happens with the appropriation account? We draw this immediately after we've drawn the income statement. Okay, yeah, and of course, right in the appropriation account, of course, what we basically do is we have two scenarios here. Okay, we have basically two accounting entries, and one is around the income and expense account with the net profit carried down. You know, as we actually move the profit we've gotten here to the appropriation account. Okay, so as we are debiting our income and expense account with the net profit, as we debit it, it means, of course, we are basically clearing it off. We are basically moving it to what? Moving it to the appropriation account for distribution between the partners, or for the adjustments before we can distribute to the partners. Okay, and then of course, from the appropriation account, okay, once we have already distributed from the appropriation account and we've gotten every contribution, every appropriation to every partner, we then move this money into the current accounts of each of the partner. Okay. So we will see how that does happen. So those are the two entries. One is bringing in whatever we are going to make adjustments to, and the other is looking at what we exactly removing from this account. Okay. Yeah. So that is very important. So in terms of steps, drawing up this, of course, ours is to first find the net profit. Like I said, first, after you've drawn up your income statement, yours is to move to, after you've gotten the net profit, is now moved to the appropriation. And by the way, that is why you see some questions may ask you to draw up the statement of profit and loss and the appropriation account. That is how it goes. So it basically means that after you've drawn up your statement of profit and loss, just proceed to the appropriation account. Okay. So that is what exactly happens. I think we saw such a similar scenario when it comes to manufacturing accounts, where we had the manufacturing account and the income statement, okay, right away, or and the trading and profit and loss account, okay. Yeah, so that is good to take note for, okay. And then the other is to appropriate interest on capital and salaries first, okay. Just in case we have any interest on capital. Now, like I said, partners, because they contribute capital to the business, yes, they get dividends, but they also have cases where the partner agreement gives them interest on capital. So after we've gotten our profit, ours is to now come and deduct what? Deduct our interest on capital. And then after deducting interest on capital for each of the partners, and then we come also and deduct our salaries, okay? For any partner that could be receiving salaries, okay? And like we are saying that these items should be in the appropriation of profit account, and they should never appear in the income statement, okay? These items should never appear in the income statement. So when you're doing a number on partnership, yours is to distinguish what will appear in the appropriation account and what will exactly appear within your income statement, okay? Yeah. And the other thing is to, after we've looked at the interest on capital as well as salaries, ours is to proceed to do what? Ours will proceed to look at the drawings. So in case partners agree to pay interest on their drawings, what we shall basically do now, when we are drawing up the appropriation account, the current account also is opened up, okay? Because there is whatever we action, whatever we are actioning in the appropriation account, we are reflecting it also in the current account. Like I said, the current account is like a mirror of the capital account, okay? Now, if, for example, we have things like interest on drawings, okay? Remember, interest on drawings, in this case, partners are, since they are the ones that took the drawings, they actually take the pinch, okay? This is not an advantage to them. And that is why we debit the capital, the current account, because in this case, the partners, they are not benefiting. The partners benefit when, for example, they are receiving interest on capital, okay? Or when they are receiving a profit that is being appropriated to them. But anything that does reduce on what the capital is, what really the partners are earning is actually debited to the current account, okay? As we shall proceed to see, okay? So once we have done that, the next is now to get the residual profits, okay? And these residual profits is basically the difference between, of course, the net profits after you've added interest that is charged on drawings. Remember, interest to charge on drawings is a benefit to the company. So it basically increases on the profit that you've brought to the appropriation account. And then you go less on the interest on capital and the salaries, and then you're able to get residual profits, okay? And then the other is after we've done that, we now do what? We now share the profits between the partners, okay? And then we later go on to balance off the drawings account as well as the current account. Now, I want to, before I proceed, I want to just show you one example here. that would give us a good indication. Okay, so this is one of the examples that I want to just show you right here. Right here. I don't know if this can give me the picture that I want to show you. Okay, at least I know you know how to do to get the net profit. Okay, so what I was trying to mean basically up there is ours is to first bring the profit here from the income statement. Okay, and then we add the interest on drawings. Remember, this is an appropriation account. It's not the income statement. The income statement helps us to get the net profit. And the income statement does not in any way differ from the income statement we have in the private sector or where we don't have partnership. Okay, so you understand. We are going to try out this. So, but just so you get this very fast before we proceed. Okay, so we add our interest on drawings. And the reason why we add interest on drawings paid to the partnership is it increases on the returns to the company. Okay, remember, this interest on drawings is being charged to who? To the partners. For what? For the money they actually took out of the business. Okay, so it's like an income, an additional income, but this is only reflected in what? In the appropriation account. So just know that this net profit that has been brought here is not yet, is basically does not include this interest. So we do all this within the appropriation account. Okay, and then once we have added the interest on drawings, ours is now also look at what? The salaries. So for example, here Lucifer, who was a partner, was actually being paid. Okay, and we are lessing that. And then we are also going ahead to less the interest on capital and the current account. Okay, and we have been provided the respective percentages there. Okay, and right away after we've deducted our salaries and deducted also the interest on capital, ours is to make sure that we get the profit. Okay, this is basically the total. This is the profit. And this profit is now distributed between the two partners. Okay, right there. And at the end of the day, you're able to get this. Now, what I was trying to indicate as well is whatever you're doing here, for example, whatever you're doing here, you're adding the interest on drawings. Now, here it is the company that is benefiting. So in the current account, as we do add this here, we have to come and debit right here. Okay, now right here you'll see that we took the total. Okay, here we took the total, but in the current account, which is very similar to also when it comes to the capital account, is that we usually have different columns, okay, of the respective partners. So yours is to have the detail and then have the column for one partner, for partner A, and then have a column, for example, for partner B. Okay, that is the debit side. And the same thing you also do for the credit side, have the detail and have the column for partner A and have also the column for partner B. Okay, so as you can see, as we added our interest on drawings here, we came and brought our interest on drawings on the debit side. And the reason why we debit this is like a partner capital account. So anything that the partner, in a way that the partners anything that doesn't advantage the partner, okay, is actually put on the debit side. And any kind of benefits like salary, because the partner is benefiting from salary, the partner is benefiting from interest on capital, and the partner is also benefiting from the profit share, all these are credited. Okay, because the partner is benefiting, his capital account is gaining. Okay, so that is, I just wanted to depict that to you from what we've just been looking up there. Okay, so that you don't miss out on the information. But we are going to go systematically, so you're able to pick the respective points. Okay, so this is what they were trying to explain right here. Okay, yeah. Okay, Yeah, so we have a case here where they're calling it a guaranteed minimum profit share. They're telling us the partner may have okay, the partnership agreement may provide that one partner has a guaranteed minimum profit share. Okay, and that means that despite the ratio that they may have, okay, despite the ratio that they may have, there's one partner who cannot get a profit less than a given amount. Okay, so we have a case here. This is Tony, John, Gordon. They're in business, sharing profits for 3 to 3 to 3 after allowing salaries of 30,000 for Tony and John. And then they are telling us that Tony has a guaranteed minimum profit share of how much? Of 120,000. They're telling us the profit for there is 260,000. Okay, so it means that this gentleman, whatever we get in terms of profit, his share should actually be 120,000. So they're just trying to ask us to show the appropriation. So I'll just show you this directly here. So what they first did so is to take into consideration our salaries, which is for Tony and share, for Tony and John, as you can see, which is the 60,000. Okay. Now, when the 60,000 is actually when you remove the 60,000 from what? From your profit, definitely you'll be able to come to your 200, your 200,000. Okay. Now, in terms of course, if you are trying to look at the residual profit share, remember the residual profit share is what? Is 4 to 3 to 3. Okay. So this would mean this would be the profit share, just in case they didn't have a minimum profit, as you can see. But after we have done that, then we have to come and make the adjustment. Okay. So as you saw, this chap called Tony, his profit share has to be what? 120. So from here, you get to see that he actually got 110. Okay. And the rest of the partners, this one got 90 and this one got 60. So he got 10,000 less. Okay, he got 10,000 less, and that would mean that they have to add him the 10,000 on the 110, so he can get to what? To the 120. Okay. Now the addition that is given to him has to be shared by what? Has to be shared between the two partners. Okay, as you can see, in terms of equal share. Okay, so as you can see right there. So that is just something that we just needed to highlight right there. Okay, so we have a question here that you can just look at, and then we can try to proceed. Just give me a minute. All right, apologies, sorry for that. So we have this question, and we have three partners. We have Loki, Nice, and Monster. Okay, they're in a partnership with an agreement to share what? To share profits in the ratio of 3 to 2 to 1. So they also agree that all three should receive interest of 12% on their capital. Monster should receive a salary of 6,000. Maybe Monster is the active partner. Usually this is the active partner that receives this. And then they're also telling us that interest will be charged on drawings at a rate of 5%, okay? Charged on the end of their drawings balances. And they're also telling us that the interest rate on loan by Loki is 5%, okay? So I think Loki gave us a loan. So that is the kind of interest that we actually pay to them, okay? So they are telling us that the statement of financial position of the partnership looks like this. So we have capital, okay? We have capital accounts. We have Loki, Nice, Monster, and then we have current accounts, this and this and this. Now, as you can see, these have been put together. Like I said, under your equity, okay? Under your equity, if at all partnership is running a floating capital system, you have these two things, the current and capital distributed. But if at all it has a fixed capital, if it has a fixed capital account, then you'll be able to see this. If it has a floating, then you will be able to see a single, only one, okay? Not to confuse you there, but the current account, in case it exists, should be under your equity, okay? Yeah, so that is what we basically do have. And then they're also giving us the loan account. This is for Loki, which is 6,000. They are telling, they are giving, okay, this is a capital employed to finance long-term assets and working capital. So basically, this that they have given us, this statement of financial position they have given us is just the equity and liabilities, okay? Is the portion of equity and liabilities. And that is why they are ending with capital employed to finance long-term assets and working capital, okay? So this will be the same value of your non-current assets and current assets, okay? As well as the working capital, okay? Working capital is current assets minus current liabilities, okay? So the current assets minus current liabilities plus long-term assets should also be able to give you this, since this has looked at only capital accounts or part of equity and only the long-term loan, okay? Yeah, so you need to understand those terms. Then they have also gone ahead to say that the drawings made during the year to 31st December 2016 were as follows. So we have Loki, that value. Then we have Nice, that value. Then we have Monster, that value. Then they proceed to tell us that the net profit for the year to 31st December was how much? Was 24,530 before deducting the loan interest. Like we saw, the loan interest should be deducted in the appropriation account. So they are right to basically give us this information. And right here, they are asking us to draw up what? Prepare the appropriation account for the year ended to 31st December and the partner's capital accounts and the current accounts, okay? So that is what we have, as simple as that number can be, okay? So once you have that, yours is now to see how do I now reflect that in to get what the examiner is interested in, okay? So just a moment, okay, right there. Okay, so the examiner, as you saw in the question, they want us to draw up our appropriation account for the year ended 31st December 2016 and the partner partners capital accounts, and the current accounts. Okay. Now, what we shall basically do, we are going to draw all the three at a go, definitely. Okay. So we shall first pick our appropriation account just to confirm whose business. This is Lucky, Niece, and Monster. Let me just pick this and take it to my working area. So I'll put that. So Lucy, Niece, and Monster. Okay. So my appropriation account is just like the way you'd actually draw up your income statement. Okay. As you saw from part of the format we looked at, is that okay, this is appropriation account. Let me just finish the naming. Appropriation account. Okay. Like that. Of course, this is usually for the period. Okay. Okay. For the period maybe ended. This is 20x/6, like that. Okay, maybe like that. I don't know. Okay. So you just do something like that. So yours is to now yours is to come back here and look at what? When you're drawing up the appropriation account, the first thing that you should ask yourself is the net profit. Okay. So this is like your net profit and the one you should start with. Okay. So net profit for the year ended. So just pick that and take it to as the first thing that I should look at before even I look at anything. Okay. So I'll have my net profit right there. Net profit. So this I'll pick this value and include it in the amounts. Maybe I'll have these columns for my amounts. Okay. Yeah. That is what I basically have in USDs. Okay. So that is what I basically do have. Okay. Now remember what they told us about the appropriation account, that after we have gotten the net profit, ours is now to go at do what? To go and add to go and adjust it with what? With the interest on drawings, which are added back. Okay. Interest on drawing is added back to the profit because the company is benefiting, so it has to be added to the profit. Okay. So we have drawings, like they have indicated for us. We have drawings right here, and these drawings, the interest on these drawings, they have told us the interest that will be charged on the drawings is what? Is 5%. Okay. Is 5% charged at the year end. Okay. Is 5%. So I'll go on to get the 5% of each of these. Okay. So 5% of 6,000. Of course, you put working, but let me just do this for a small, since we are trying to do this together. 5% of this is 6,000 times 5%. That is about 300. Okay. So yeah, I hope that is right. It's about 300. So I'm going to come here and say add interest on drawings. Okay. I'm going to add interest on drawings. So my interest on drawings, like I indicated there, I have for Loki. Okay. You can get the total, you can include the total, or you can basically distribute them. Okay. Niece and Monster. Okay. So as we saw, Lucky has drawings. Lucky has had drawings at 6,000. Okay. Lucky's drawings are 6,000. So if they are 6,000, what that means that 5% of 6,000 will actually be 300. Okay. And then the next person who is niece, her drawings are 4K, okay? So niece's drawings are 4K, which is 5% of 4K. 5% of 4,000, right there, okay? And I think the other is 7,000. 5% of 7,000, like that, okay? So this should be able to give you, just a moment. Let me just try to reduce these columns. So, okay. So when I get a summation here of all these, this gives you 850, okay? That gives you 850. So 850 has to be added on our interest on, has to be added on our profit, okay? We have to add it on our profit. So right there, when you add that 850, you basically come to summation of these, basically gives you 25,380, okay? So you can now go proceed to less, okay? Now, the things that we less, remember they told us that we less interest on loan, because it deducts, it reduces our what? It does reduce on our profits before we distribute them to the partners. Then we shall also less salaries, okay? But I'll still distribute this since we just confirm that we have any interest on loans, just right here. Let's just confirm this. So interest on loans, when you come to, we only have a single interest on loan, okay? And this loan is by Loki, and it is 5%. So you understand that the loan by Loki is actually 6,000. So you're able to calculate the 5%, okay? So I'm going to take 5% of 6,000, okay? So that's what I'll do, take 5% of 6,000. Oh, that's a minus 5%, 5% of 6,000. That gives me about, is it 300? Okay, that gives me about 300. Okay, the other next one is I should also less salaries. Okay, I should less salaries, and I should also less the interest on capital. Okay, so what that would mean that I'll look through my question and see if I have any salaries. So any salaries that I do have, they're telling me that Monster should receive a salary of 6,000. Okay, so I'll just come here. Okay, interest on loan. I can try to put the bracket who this was. I think this was Loki, a loan, and then we have less salary. Call it partner salary. Now, the salaries of the staff, of other staff, are actually deducted off in the P&L, okay? So here you only deduct the partner salary, okay? And in this case, it is Monster. Monster is earning a salary of 6K, I think so. Yeah, 6,000. Is 6,000 right there. So just come and deduct it here. 6,000. After I've done that, I should also less interest on what? Less interest on capital. If you don't understand anything, please you let me know, okay? So interest on capital, definitely all the partners will have an interest on capital because all of them have contributed capital, okay? So what I'm going to basically do is look at their capital respective capital balances. So we have, as you can see, we have 20,000, 8,000, and 6,000. Okay, and they're telling us that the partners agree of a 12% on what? On the interest on capital. Okay, this is the capital that we have. So we are going to charge 12% on each of these. Okay, yeah, so that is what we are basically going to do. So I'll start from here. So when it comes to Loki, as we have seen, Loki has 20%. Okay, Loki has 20%. So what that would mean with Loki, this will be 12% times 20,000. Okay, I hope that is what we have, which is 2,400. And NIS had 8,000, which is 12% times 8,000, which gives me 960. And Monster had 6,000, which is 12% times 6,000. Okay, you can include this within your working, or you can just include it right here. Say 12% times, it was 20,000. So the examiner can basically know where you go to the figures. Yeah, don't always assume that the examiner knows. Okay, yeah, just assume that you make sure that whatever you're answering the exam, you're not leaving any question mark. Okay, that the examiner may think that you intentionally did that. And some of these calculations could be the ones that will give you the marks or confirm to the examiner that you didn't copy. Okay, so just add this. This gives me 4080. Let me just try to put a separate here. This is 4080. So once I do have that 4080, mine is now to calculate the distributed profits. Okay, profit to be distributed, because I've already adjusted with everything that I do have. Profit to be distributed. So remember, this was we had this, and then we are lessing this, lessing that, lessing that. So I can basically just get this. Since they already have a negative, I'll just add them. That is Excel. Okay, getting me to 15,000. Okay, 15,000. So we are going to distribute between the partners. Okay, of profit distribution or allocation, whatever term you might use. We are going to have still the partners listed together. Okay, so we have Loki, NIS, Monster. Okay, now as ours is to find out and see what are the ratios of sharing between the partners. Okay, what are the ratios between the sharing of the partners? So when you come here, they told us the partners share profits in the ratio of 3 to 2 to 1. Okay, 3 to 2 to 1. So I'll just pick that right there and go take it to the other side. So I'll come here. I can even have a working here. Okay, my working. So that is what basically I do have. Okay, it is 3 to 2 to 1. So it is 3, 2 to 1. Okay, my total ratio is basically 6. Okay, just to confirm, since I didn't copy this, 3, 2 to 1, and it is Loki, NIS, and Monster. Okay, so basically my total ratio is 6, as I have said. So if my total ratio is 6 here, it means that Loki will have 3 divided by 6. Okay. Wow. Okay, this one will have 3 out of 6. This one will have 2 out of 6, and this will have 1 over 6. Okay. So when I'm distributing this profit, it means that under here, I'll even distribute from this column, okay? Under here, for Luki, this is 3 divided by 6 times what? Times the 15,000, okay? Like that. Then underneath it will be 2 divided by 6 times what? Times 15,000, that. Then for Monster, it will be basically 1 divided by what? Divided by 6 times what? Times 15K, okay? So as you can see, we've basically distributed all the profits because its total is basically what? Is basically 15K, okay? That is what we basically do have, and we have distributed our profits right there, okay? So that's how the appropriation account basically would basically look like, okay? Now, yours, after you've drawn up your appropriation account, definitely, yours is to continue with the rest of the accounts, okay? So the rest of the accounts, like they indicated, they asked us to draw up our current account, okay? And then they also asked us to draw up the capital account. Now, the capital account and the current account take they take a T format, okay? They do take a T format. And what I'm basically going to do is I'm going to draw them up here, okay? Now, I would have drawn them along together, but since we are learning, I didn't do that. But we shall learn, okay? And then right here, okay? So this one can be my capital account, and then I can have my current account, okay? So that is what basically I do have. So like I said, most, especially when it comes to this, usually we have the detail, okay? And then we have some light on interest on drawings. Okay, I'm going to give you more light on that. So we can have a detail. Let this be the capital account. Let me just pick the title of this. This is Lucy, Niece, and Musta. Okay, I don't know which country these names might be. Okay, but for learning purposes, just appreciate. So Lucy, Niece, Musta. This is a capital account. Okay, and then like I said, this is the current account. Okay, now before I do, let me comment on interest on drawings. I say that interest on drawings, partners take money out of the partnership, okay? And because we don't want to encourage them to keep taking money out of the partnership, we may charge them what? We may charge them interest on drawings, okay? So if you're to look at our question, the question that we've just tried to work on, we actually had, they gave us a case scenario where we have drawings, okay? Maybe just to go there so you can see. So we have drawings here. They told us that interest will be charged on drawings at a rate of 5%, and this is charged at the end of the year, okay? So ours is to find out what are the drawings in the period. So they're telling us that during the year 1st to 31st December, drawings were to the following. So these are the drawings we have. So since we have an interest on drawing, which is 5%, if we want to find the interest on drawing, we come and subject the 5% on each of them. And that interest on drawing should be added to our net profit from the income statement. The reason why we add it there is that it is the company that is charging interest. And we know that interest is an income if it's the company that is charging it. So in that case, that is why we add it back to our profit, okay? So I hope that one is okay for you, George. So yeah. So back to business here. So I say that when we're drawing up our capital account and current account, these are look-alike. They have a normal credit balance. Basically, we have the detail, and then we can have the different columns of the partners. So we shall have Loki here. Loki. We shall have Nis, and we shall have Monster. Okay. So I'll have the same thing on the credit side right there. Okay. And also in the current account, since these two accounts are look-alike, to have the same thing right there. So that is what we'll basically do have. So once I have that, main is now to proceed to do what? Main is now to proceed to put the information. Now, in both the two accounts, we start with what? We start with the balance brought down. We start with the balance brought down, especially for businesses that are continuous. There will always be balance brought down for each of these, okay? So I'll put my balances brought down there and also put my balances brought down there, okay? So once I have that, once I do have that, main is to proceed to what? To look at my question and speak the balances. So as you can see, this one has 20,000, 8,000, and 6,000. 20,000, 8,000, 6,000 in capital. 20,000, 80,000, and 6,000. Okay. I'll just put it as my separator. So that's my balance brought down for capital. Okay. Then I'll come and pick also when it comes to the current account, as you can see. Now, as you can see, one person has a current account that is negative. So that is possible, okay? It means that in terms of the operations, they actually had more things that we are deducting from their current account than what they were benefiting from, okay? As we shall see. So we have 3,500, negative 700, and 1,800, okay? So we have 3,500, we have negative 700, and I think this was 18. Was it 18? 1,800? Yes. Okay. Like that. So that is what we basically do have. Those are our balances brought down. Okay. Now, after we're done with including the balances, the respective balances, the next thing that we are going to look at is aspects of what exactly changed, okay? What exactly changed within the current and the capital account during that period, okay? Now, in most cases, since we have a current account, we'll not have any much change that appears in the current account, okay? We shall not have any much change that will appear in the current account, but all the other things that we have seen happening in the appropriation account, they will definitely affect our current account, okay? Yeah, so that is what we need to basically understand when we are drawing up these accounts. So this one, this is a fixed capital account. As long as you see a current account, then you know that it's a fixed account, okay? So in the case where you have a negative here, instead of putting it as a negative here, remember this is a T account. So instead of putting it as a negative here, what you'll do is you'll come put the balance brought down here and put it under here, okay? The same principle, this is the same principle, okay? So put it right there. So now, since I don't have anything that affects my capital account right now, main is to ask myself, whatever I had in the appropriation account, what exactly could affect my current account, okay? So remember, I'll start with interest on drawings, okay? Now, remember what happens with interest on drawings. Interest on drawings, who is benefiting? The company is benefiting, okay? And who is losing? Of course, the partner, because this is interest being charged to them. So this one, interest on drawing, should be put on what? On the debit side. So you should have interest on drawings right there, okay? And then you come and now put the figure 300, 200, and 350. 300, 200, and this is 350, like that. So that's how you would put it right there, okay? Now, next thing you move to is when it comes to interest, the loan interest. Now, the loan interest, as you can see, the loan interest is charged by who? By the partner. So the partner benefits. So I'll just pick the loan interest and take it to the credit side, because it's the partner who is benefiting, who is getting this loan interest. So I'll come here and include loan interest. This is low-key. Even if I don't have to include it in bracket low-key, I'll just pick the amount. So you can see that there is a relationship between what? Between your appropriation account and your current account. So I'll pick the interest on, it was here, 300. This side I'll put it as a positive, okay? This is 300. You don't have to put it as a negative again, okay? Yeah, so that is very important. Now, the next thing you need to look at is the interest, okay, the salary, okay? We can look at the salary. The salary should also appear the other side, and this is for Monster. So I'll just carry this and put the 6,000 under the column of Monster. So that is why I said you can do this along each other. As you input the other side, you come and input this side, okay? So this is 6,000, like that. So after I'm done with that, I now come to interest on capital. So interest on capital also is the partner that is benefiting. So I'll have interest on capital, and I'll come and distribute the respective amounts that I have gotten from my interest on capital, okay? So interest on capital is 2,400, 960, and 720. 2,400, 960, and 720, okay? Just to confirm that is what I've written. Yes, okay? Yeah. Once I do have that, mine is to now proceed and look at what else do I have? Apart from interest on capital, I also have profit distributed, okay? Now, profit distributed in this case is also a benefit to who? To the partners. So it means that profit distributed should also be done what? Should be credited, okay? So as I have them there, I'll just come here, okay? On where I have my credit side, say maybe profit distribution, and we had 7,500, 5,000, and 2,500. This is 7,500, 5,000, and 2,500, like that, okay? So that is what we basically do have, okay? Now yours is to ask yourself, is there anything else that I've left out? Yes. What is that I've left out? Are your drawings, okay? Now drawings also, in addition to the interest on drawings, you should also bring the drawings in what? In the current account, okay? So yours is to go back to the question and check and see the drawings. So the drawings we have are 6K, 7K, 6, 4, and 7. 6, 4, and 7. 6, 4, and 7. So drawings 6, 4, and 7, like that, okay? So that is what we basically do have, okay? And once you have that, yours is to ask yourself, is there now anything else that I might have left out, okay? So based on what they have given us, the information they have given us, that should be all, okay? So the next thing I need to do is to balance off my current account. I'll balance off my current account, okay? So what I'll basically do, I'll add the different columns. Now, the current account, of course, has a normal credit balance. So in most cases, this side will be more than this, but at some cases, you can find this side more than this side. And that's why we had a balance brought down of negative, okay? In that case, that means that this side was more than in the previous financial period, okay? So what I'll basically do, I'll start with this side. Since I'm using Excel, this will be much easier for me. Summation of this. So you press your calculator there, able to add. Okay. And then since this is what I have this side, mine is also to add what I get this other side. Okay. So this other side has 6,500. It means that this will be 13,700 also. Okay. And then I'm going to have a balance carried down. Okay. And what this is 6,300, 6,300. So what I'll do have, basically do have that minus 6,300, like that. So that should be able to give me my total, okay, right there. And then this one, niece who is, let me just try to see this. When I add this gives me 5,900, okay? So this is 5,960. So the balance, this should be about 60. I hope so. So it means that that would take me to 5,960, okay? Yeah. Oh, no, this was just confirm, this was 4,900, okay? So this should be, if this is 4,900, 5,960 minus 4,900 gets me 1,060. So when I add the two, they now match, okay? I'll come to this one. This is 7,350, and I have 11. So this would definitely be the total here, okay? And then I'll have a difference here, 7,350, which will basically be this minus 7,350, which gets me to that. Okay, 11,020, like that. So that's what I have. In the same way as I have this, I'll come and bring it right here. No, that's not what I wanted. Let me just try to change. This is, I'm pasting values. So that's what I basically do have. And this will be my balance brought down or brought forward, like that, okay? So I hope that is understood. So that is what we have as our current account. So I hope you've mastered that one. And that's where the principle lies when it comes to this. Of course, this I can just balance off. There was no change. This account would only change cases where we have introduction of new capital, okay? And the new capital may also come in forms of maybe the loan, one of the partners' loan may be transformed into capital, okay? So basically, same principle. This is a balance carried down, okay? And then you have the same totals here. Same totals, and then you have a balance brought down. Yeah, like that, okay? Like that. And then you have your appropriation account here, you have your current accounts. So you should be doing well, okay? So one of the other things that they asked us, if you remember the question, they asked us, basically that is what they asked us. They basically asked us to prepare the appropriation account and the partners capital accounts and the current account. Okay, that is what they basically asked us. So I hope we have no question at this level. Any questions that you might have at that level, because that is the gist of partnerships. Okay, other things that we are going to be doing are things that just keep on giving us more insights on what to basically do. Okay, but that is the gist of partnerships. Maybe what I can basically just show you how the balance sheet will look like. Okay, now this is how the balance sheet will look like. So the statement of financial position at the end of the year would come and release the capital accounts, which we have just gotten here. Remember, the capital accounts remained 28 and 60. Okay, so the same way they have remained is the same way that you'd actually bring them here and get your value. And then your current account has now changed, and these values, the 7,400, you'll be able to see it right here. Okay, I think you saw down here we have 7,400, 1060, 3670. So these are your new current account balances. So those you'll be able to include them right there. Okay, and then of course the loan still exists. We shall include it here. Remember, we just charged its interest, but the principal still remains, and this will definitely give us our what? Our net assets. Okay, as at what? As at 31st December 2016, right there. Okay, yeah. So just to add anything added during there. Now this is like the profit. Okay, this is the profit. Remember, net profits are also added to the equity. Okay, like they are part of the retained earnings. But since we didn't start with any retained earnings, ours just come and recognize what? Recognize the net profit. Okay, so what do we do here? Now they gave us the net profit, which was 24,230. Okay, but we also have the drawings. Okay, so we are bringing the profit as well as the drawings. So you can alternatively include just maybe profits, net profits, and then include the drawings. Okay, distributed between the respective partners. But as you can see, we've just added them together to come to 17,000 and include that and include the difference, which is 7,230. Okay, and then also adding the Loki's interest, loan interest, which ideally they didn't tell us had been paid. So we are including it as what? As something that has to be added back. Okay, because it is it's like an accrual. Okay, so that's why we're bringing in the 300 right there. Okay, and at the end of the day, we should be able to come to our 52,130. Okay, right there. So that is just something so you basically understand. Okay, yeah. All right, so that is what happens with the partner accounts. So yours is to master this, by the way, the current account, how it looks like, what it should be on the credit side, what should be on the debit side, and yours is to also do this. Okay, so we did one time we did a class, a revision class of partnerships. So I'm going to share with you. You remind me to share with you that link, so you can watch that session of partnerships, us trying out an examination question that would be really very helpful to you. Okay, and also help you, especially for my friends that are preparing for the exam, but also for you as well. One of the things that you need to realize is that for every topic that we finish, we definitely move on to something else. Okay, yeah, so you need to see how you can get some time, master these things, go through all these scenarios. So After we have looked at that, the next thing that I want us to basically look at is the changes in partnerships, okay? Is changes in partnerships. So we have to realize that partnerships, like any other business, and since we have partners in there, more than one person, we have cases of changes, okay? And these changes definitely, one of the things they affect is the profit sharing arrangement, okay, between the respective partners. So we have a case also where a partner retires, like I indicated earlier on. It means that we have a change in profit sharing ratio. Also cases where we have an additional partner joining, okay? Yeah, so we have an example right here. And this example goes by Hook and Line have been in a partnership for many years, and they have been sharing profits equally. So on 1st October 2018, Folter is admitted to the partnership. So he joins Hook and Line, okay? And it is decided that Hook, Line, and Floater will now share profits in the ratio of 4 to 4 to 2, okay? The net profit for the year is how much? The net profit for the year is 150,000. So they're asking you, show how this will now be split between what? Between the respective partners, okay? Yeah, remember, this is very key. They were sharing previous profits equally, okay? So they were sharing, this is 1-to-1, okay? This is a 1-to-1 ratio when they say equally. It can also be to 2-to-2, but basically it's 1-to-1, okay? Yeah, so they have been sharing equally, and they're now moving to what? They are now moving to 4-to-2, 4-to-4-to-2, okay? So just not to waste a lot of time, I'll just show it right here for you. So between January and September, okay? Between January and September, remember, this guy came in what? This guy was admitted when? This guy was admitted 1st October 2018. And remember the profits we are sharing? The profits we are sharing are for up to December. So this guy was basically with us for how many months? Was basically with us for October, November, and December. Those are basically 3 months, okay? Those are 3 months. And once you get 3, basically just to determine the profits that are attributed to the 3 months this guy came, 3 out of 12, this is 0.25 times 150,000. This gives you 37,500, okay? So this 37,500 is what we are sharing on this ratio, on the 4-to-4-to-2, okay? But the 112 for the months from January to September has been shared by what? Has been shared in equal shares. So we first share the profit before this guy joins between the two partners, which is 5-5, okay? Or 1-1. As you can see, he got the same as he got this one, okay? 50-50. And then when it comes to October to December, we are sharing the 37,500, which is just 3 out of 12 of what? Of the 150,000. Basically, the profit that is attributed to what? To this period, okay? So that is what we basically do have, and that's how we are sharing. So at the end of the day, this will be their fair share of the profit, okay, between the partners. So that is as simple as that. So the principle is just for you to know the aspect of when the partner came through and how to play with the different ratios of sharing, okay? Yeah, so we have another aspect called goodwill, okay? So we cannot speak about partnerships and forget about what is called goodwill. Now, goodwill, I think you've maybe seen goodwill in other contexts. Goodwill is an intangible asset, okay? And for a private company, I think you've heard that where a company is selling and it sells with goodwill, okay? Now, goodwill is the customer loyalty, is basically a reward for having existed either in business for some good time, okay? So when partners are in business for some good amount of time, they basically earn what they call goodwill, okay? Goodwill. So we have goodwill that arises when one of the partner, of course, is exiting, okay? We also have a case where a partner is joining. Now, the partner who is joining, because they have not been with the partnership, they will definitely pay for the goodwill for the existing partners, okay? Yeah, so we have a case here where a new partner is admitted. So we need to understand that how to calculate basically goodwill, okay? Now, so we have a case here, an example here. Just maybe a comment here, goodwill should not be left in the statement of financial position. For the private sector, goodwill is recorded under intangible, non-current intangible assets, okay? Yeah, goodwill is like the trademark. Trademark is also an intangible asset. Patent rights is an intangible asset, and so on. So just for examination purposes, know that you should not leave this in the statement of financial position, okay? So example we have for goodwill here. So they are telling us that in the case of hook, line, and floater in the scenario above, assume that the business had a goodwill of 300,000 at which date? At 1st October 2018, when this guy, I think Hook was joining in. I think it was Hook who joined in. Yeah, if I'm not forget. So Hook joined in. Okay, actually Hook and Line have been partnerships. So it's Floater who was Floater was the one who was admitted at 1st October 2018. So they are telling us that let's assume this partnership, excuse me, had a goodwill of how much? Of 300,000. So what that would mean, if at all we had a goodwill of 300,000, we are saying that the partners request that the goodwill is created and then reversed out in each change, okay? So we are going to see how that applies exactly, okay? So this is the scenario, and we have the two accounts, okay? So this is our current account. Now, our current account, as we saw, records, of course, operations between the partner and the business, okay? So we have a case scenario here. Now, we have calculation of goodwill, okay? Before and after. So remember, before this guy joined, these guys were sharing profits at what? At equal share, 50-50, okay? 50-50. And that would mean that if that existing goodwill, in the same way, just like profit, the profits share, the share of this goodwill was what? Was actually 150-150, okay? Was actually 150-150. So in my current account, the balance that I have is 150 and 150 because these are the existing partners that were Hook and Line that were existed. So that the goodwill that the business had was also in the ratio of 50-50. Now, after this guy coming through, they had an alter or change in what? In their profit share. And remember, their profit share went to what? To 4-4-2, okay? 4-4-2, and the total ratio here is what? Is actually 10. 4 plus 4 plus 2 is actually 10. So you're going to see the dynamics of how they share the 300. So it's 4. Remember, it is 4-4-2. So 4 out of 10 times 300,000 gives me 120, and then it gives me 120 as well, and then it gives me 60,000. Okay, so we credited right here because this is what we started with, and this is what we basically do have. Okay, And here we are trying to reverse out the goodwill. Now in the goodwill account, remember, goodwill has what? Goodwill is an asset, so it has a normal debit balance. So that's why we have the 300,000 here, okay? And then it is being balanced off by 300,000. Now, the reason why you're seeing it being balanced off like this is that they told us that goodwill should not appear in the statement of financial position, okay? So it should not remain in our books. So that is why we are writing it off right there, okay? But as you see, we were able to do what? We are able to create it and then reverse it accordingly, okay? Now, one of the things that you need to know is that once we have this, it means that Floater, who is the new partner, okay, he has to do what? He has to pay for his share of the goodwill, okay? He has to do what? He has to pay for his share of goodwill, okay? And because one of the things that happens is because the goodwill, when it comes to the share of goodwill for these other partners who can what? Align, the original diminished upon his admission, okay? So he has to pay a share of his goodwill, okay? So that is just so you understand. So we have another scenario here where we are saying the calculation of goodwill, okay? So as we have seen, just maybe in the exam, you are likely to be asked to calculate goodwill. And goodwill is basically the value of the business less the net asset value, okay? Now, in the other question, they actually gave us this goodwill, the 300,000, but just in case they don't give you that, the study guide is telling us that let's get the value of the business, less what? Less the net assets, okay? So we have a case here that is going to give us that picture where they're saying that Hook, Line, and Floater have continued trading for a further year, and they are considering admitting who? Sinker, who is coming on what? On 31st December 2019. So they are telling us that for purposes of calculating goodwill, the partners obtain a valuation of the business if it were to be sold, and the valuation of the business is what? Is 750. And they're telling us that the statement of financial position as at 31st December 2009 would show a net assets of what? Of 375. Definitely, if the valuation is 750 and this is 375, the difference should basically be goodwill. So as simple as that, okay? So that is for you. So they'll bring you a long number, but they'll have maybe a statement like this that you want to test you on if you know how to calculate the goodwill. So if goodwill is not provided, then you just get the valuation of the business less the net assets at that point in time, okay? Yeah, so that is what they wanted to basically deliver here, okay? Yeah. So that is basically what I would share under here. So this is just a roundup and a few quiz questions that you may need to take home. So we have another part of course, of partnerships, which is closure of partnerships, but I think maybe that I'll be able to handle it. I'll be able to handle it in the next class, okay? I'll be able to handle it in a class, or what I'll actually do, we'll have a class on Tuesday. Yes, we'll have a class on Tuesday. So the class on Tuesday, I'll do a number that involves retirement or not basically retirement, but closure of partnerships. So that should be able to help us learn more about partnerships, okay? Yeah, so I hope you've appreciated partnerships from that level, okay? I would encourage you to read more about them. I'll try to share the notes with you, the ones that we've just gone through. But just in case you also get any other, I think you know, when it comes to partnerships, they're a bit broad, okay? They're a bit broad, but make sure that at least you understand the basics, okay? You basically understand the basics. So that is very important. So I was just trying to check my course outline here, maybe just to show you what I'm trying to check. Like I told you that every time you're done with something, then you interest yourself in looking at what the course outline does, or the syllabus does. Okay, so the partnership agreement, by the way, can also be called a partnership deed. Okay, so don't find a partnership deed and then you ask yourself what the partnership deed could be. And of course, its contents, types of partners and the obligations to partnership, accounting rules. Now, types of partners, we have active partners. Okay, we have active partners. We have, of course, dormant partners. Okay, we have dormant partners. Of course, from the word active and dormant, you should be able to know that one of the partner is actively involved in the business, and one of the partner is dormant. So in terms of implication, the active partners definitely take what? Take a salary, okay? Because they contribute to the business. We also have what we call the sleeping partners, okay? We also have the sleeping partners. We also have the secret partners. We have the partners by estoppel, okay? Yeah, the active partner can also be called a working partner, okay? And a sleeping partner, this one, of course, is also more of a dormant partner. And this one basically contributes capital to the business, but does not take part into the business. So it's called a dormant partner, but can also be called a financing partner, okay? We also have partners who are called nominal partners, okay? And make sure you're noting what I'm telling you, because you'll not find this in the notes. And nominal partners, this one does not contribute capital, neither do they take active participation into the management, okay? Usually, the contribution to in the partnership is just allowing the partners use his name, okay? Allowing the partners use his name. Maybe this could happen in audit firms, maybe where a partner is, maybe, for example, myself, I'm still in normal employment and I want to recruit some people who can run the business, but I'm just a nominal partner, okay? Yeah, so we have that case. But of course, you know that if it comes to, let's say, like you're running an audit firm and you are basically a nominal partner, you still have the liability in the face of ISPAL, just in case anything happens, okay? Then we have partners by estoppel, okay? Now, this one is not a partner of the firm, okay? But then his words and conduct lead the outsiders to believe that he's actually what? He's actually a partner, okay? So this might be a case where, let's say, one of the partners fails to give a note for his retirement. So another person comes in and they act more as for sort of a partner, okay? Yeah, a secret partner is a partner where usually part of the firm, but he's not basically, his name is kept as a secret, okay? Yeah, so like that. Then a partner in profit is a partner who shares profit, basically. So those could be the types of partners that you could look at, okay? So the obligations to the partnership, like I've been indicating each of the obligations. Accounting rules from the Partnership Act, Partnership Agreement Deed, as we saw, of course, in the partnership agreement can go ahead to tell you exactly how the partners are distributing the respective profits and so on. I would give you an assignment to go and look at the Partnership Act of Uganda. Okay, just interest yourself into the Partnership Act. I think this is the Partnership Act 2010, yeah. Just try to go and interest yourself and see what does it say in terms of accounting. Okay, what does it say? You'll be able to, you can find this online. You can look for it. I think you can find some PDFs online. Just search Partnership Act. Okay, yeah. So you'll be able to go through and see what it says about accounting. And then partnership accounts, type and format. We have seen those ones: the appropriation account, the partnership current account, and so on. Okay. Then the preparation of partnership capital accounts, fixed and fluctuating. Now, fixed capital, when we have a fixed capital account, is like what we just had in the example. Okay. That means that in that case, we shall have a current account. Okay. So a current account comes in when we have a fixed capital account. Now, a fluctuating capital account, what would exactly happen? Just to show you from what we have in our scenario here, just show you something small. Wow. So what we shall have with the capital account that is floating. So in that case, we shall not have this so-called current account for a floating capital account. So our capital account will look like this. I'll try to delete this. Okay. And we'll actually just go ahead to delete this as well. So I join it up there. So this is what will happen with our capital account. It will basically have all these details that were in the current account, and that is called a floating capital account. So if the examiner asks you to draw a floating capital account, it means that you don't have to draw a current account, but rather whatever goes to the current account, come and mix it up with and have a single capital account. Okay. Yeah, so that's very important for you, and I hope you were able to see what I have just done. Okay, so right there, and then we have the appropriation of profits. We have done that, the dividing of profits and maintaining equity between partners, treatment of share of profit, losses, interest on capital, interest on drawings in the ledger accounts, and preparation of the appropriation account. We have done that. We've been able to do preparation of statement of P&L. Okay, did we do that? Yes. Okay, and the statement of financial position. I showed you how statement of financial position would look like, just in the same way as what a private does. Okay, and then we have the changes in partnerships, on admission, on retirement, dissolution of partnerships. Now this is what we shall basically look at. Okay. And we shall also look at this one, the dissolution of entries, including the role in Ghana and Mali. And then we have the preparation of financial statement of position after revaluation of assets. So we shall basically just concentrate on this. And yes, we shall call it, we shall call it a day. Okay. Yeah, so that gives you an insight. But like I said, there are really many questions on partnerships, and what you have right now can actually allow you to do any question in partnership. So like you saw, for example, this question that is in May 2018, you saw that it gave us, it came here, told us that Okol and Akol are partners in True and Fair Associates, an audit firm providing audit and consultancy services. So Okol and Akol share profits and losses in the ratio of 3:2. Okay, so you know that the total share here is 5. So this one has 3 out of 5, and this has 2 out of 5 respectively. Their trial balance for their ended 31st December is shown as below. So this is what we have, their trial balance, okay? Now, as you can see, website subscription costs, these are the normal expenses, and this will go to within our P&L, okay? The same thing, just like the way you do a P&L for any, the accruals, furniture and fittings, all those remain the same, okay? Even when it comes to now, the only differences will come to here, like we have seen. So they have given you the current and capital account of who? Of ACCA and OCCA, okay? So when you're drawing up your current and capital account, then you're able to make the respective adjustments, okay? Yeah. So, and then they come and give you the different additional information. Now, you get to see that just like the numbers we've been doing, actually, I think we might have did maybe this question, okay, in one way or the other. The same things that you do with depreciating, the same things that you do with recognizing outstanding fees and so on. There is totally no difference, okay? There is totally no difference with what we do in the private sector. The only difference comes with the appropriation account, and also cases where you asked to draw up the statement of financial position and maybe the current account, okay? So don't find this number and say, this number is about partnerships, I didn't study this topic, and then you leave it. The only thing that is here is just on the appropriation account, which is simple, which we have seen how it looks like. You now know what will appear in the appropriation account. And if I'm to look here to see what will appear in the appropriation account, definitely after you've drawn up the income statement, just in the same way you draw up for the private sector, you get your net profit. So your net profit is the first thing that goes to the appropriation account. It can also be a loss, by the way. It's not that only partners only share profits, they can also share losses. So what this would mean is that when you come to your appropriation account, you take your respective net profit. Let me just see if we have any. We don't have a partner loans in this case. We don't have, I don't know, maybe in the additional information, maybe we have a loan. Let me just try to check and see. Okay. So they're saying in 2017, the firm introduced giving partner salaries effective from 1st July 2017. So they're saying ACCA and ACCA are entitled to annual salaries worth this amount. So you know that these salaries, they're even telling you that these salaries have been included in the staff salaries. So like I said, the salaries that go to the normal income statement are only staff salaries. And these salaries for OCCA and ACCA should go in the appropriation account. So if I was you, I would definitely adjust this from my salaries, the 16 million and the 12 million. So the salaries they have given you up here, as you can see up here, the staff salaries, this 20 million they have given, okay, yes, 20 million they have given you is also, they are telling you, I think I got it, I hope I got it right. They are included within there, the 12 million and the 20 million. So yours is to go and adjust them, okay? And include them where? In the appropriation account. And you know very well with the appropriation account, we get the net profit and add any drawings, any interest in drawings. But in this case, I don't see any interest in drawings. So you leave that out. The next thing that you should be doing is to less any interest on loan or interest on capital and then salaries. So the only thing that is there is basically that actually there is an interest on capital. So this is 10% of interest on capital. You just get the capital balances here. You have 9,800 and 8,700, and you get the respective what? The respective percentage. You subject the 10% on this. So that should be able to give you the respective interest on capital that you do what? That you less within your appropriation account, okay? Just like the way what we had right here. Remember what we did right here when it came to interest on capital? We came and lessed it to be able to come to this value. In the same way, we saw salaries. So salaries, you should also bring them and list them. In this case, we have a call and a call that is earning. So you bring them right there. Okay. So that is what we basically do have. And then this profit, of course, this profit is coming from the income statement, which you first draw up. And that income statement, just draw it just like, you just even first close your eyes like there are no partners, okay, in the organization, and just draw it the same way I taught you on how to draw this when you're doing a normal income statement for any kind of company, okay? So the examiner in this question just wanted to test a little bit of the partnership, okay? And the rest of the things, the depreciation, the provision for doubtful debts that they have included down here, the 2% on doubtful debts, the same principle, okay? Should be able to understand that. And then right down here, they're asking us to prepare journal entries, which journal entries basically you should be able to know up. And then the P&L, and then the profit and loss and an appropriation account for true and fair, okay? So as basically as that. So that is something for you to know. So I hope this is clear and I hope you're able to understand this, okay? I'll be able to share with you the notes for today. But guys, let's make sure that if we have any balances, especially for my friends that have walked the journey from, I think we started around July, okay? Yeah, I also need to get salary. Today is 26th, I should also get salary for my teaching. How do you see? Because when the month ends and my bosses tell me that there's no salary, you see how it feels. I will come here demotivated. And you know that when I come here and I'm motivated, we're able to run through the 2 hours and you may not even realize that we have done the 2 hours because I'm able to give you my best, okay? So make sure that if you have a cap balance, pay it so at least my salary can be topped up, okay? Otherwise, thanks so much and wishing all those that are preparing the best. Let me see how I look into my program. I'll do some, I don't know if you guys have taken leave, but I may choose to do some classes maybe during the day or during early morning or during the evening, okay? Yeah. So to my friends that, Betty says you need to be paid. Yeah, I need to be paid. So to my friends that are preparing for December, I don't want you to be on pressure when we get to the late November. And I don't want you to be relaxed, okay? So I want to encourage you that for every topic we have done with you, yours is to make sure that during this time, you're trying out at least as many questions as possible, okay? And I told you this clearly and openly, that the exam will not have questions coming from Mars. The exam will just get, the examiner will just get questions from past papers, include just a little juice right there and include the word COVID, and you're like, oh, this examiner has even said about COVID, and we'll just give you the question right there, okay? So make sure that you're using that. And I want to tell you that if you at least use that method, you're going to become a prize winner, okay? Who doesn't love to be part of the prize winners? That makes your name shout. And I also feel proud when I see my students passing some of these things. And this knowledge should not only end in this class. This is something that you're learning for a lifetime, okay? At the end of the day, these are things that you'll apply at work, because if you're applying for a job to work in a partnership founded company, this information will be needed. Somebody will just get to the panel and ask you, tell us what a current account records. And you're like, okay, current account records interest on drawings, interest on loan, drawings themselves, things to do with profit share for the partners, and so on. So, okay, yeah. So that is what I basically wanted to comment. Okay, so for my friends who are preparing for October, please reduce on the hours you're sleeping. This is reality. You remember that the way you used to read for A level is the same way you should be reading right now. Make sure that after this class, you take your supper. If you didn't take it earlier, make sure that before you go to sleep, at least you try to calculate a number there. Don't give these things rest. Just sacrifice in the remaining time and know that at least after this period, you're actually there. Okay. Yeah. So thanks so much, and wish you good luck, and wish you the best in the rest of the night. Okay. Yeah. So bye bye. I'll share with you the notes. Okay.